service revenue up 9.4% in constant currency. I think that's a really good result considering the circumstances. And in fact, in reported results, our service revenue was up 18%. You see in the chart two of our significant growth drivers, our data business growing at almost 33%, up to 22.7 billion, and also a very strong performance from fintech, and we'll dive into that as we go through the slides. We've exercised and continue to execute on our group efficiency program, and you'll see there that our adjusted EBITDA grew just short of 11%, so growing ahead of service revenue, which meant, of course, that our EBITDA margins continue to improve. If we look at one of our key metrics, which is the adjusted headline earnings per share, which strips out one-offs, non-recurring items, that was up 53.6% in the first 6 months of the year. In terms of the investment and the balance sheet, we invested 10.1 billion rand in CapEx in the first half, focusing on capacity and resilience, and we've upped our CapEx guidance for the full year from 22 billion in Q1 now to 24 billion. The group leverage stable at 1.1 times, and we did see an increase in the holdco leverage ratio, mainly driven by the weakness of the rand against the dollar and some delays in upstreaming from the markets. And of course, as you heard last week, the board has resolved not to declare an interim dividend in light of the COVID uncertainties, and we will review the final dividend in due course. Turning then to COVID-19, we introduced this framework in our Q1 results that we basically look at it across the dimensions you see on the left-hand side of the slide: social, commercial, network, supply chain, funding, and liquidity. And what we've set out for you here is what have the impacts been, how have we managed the crisis in the short term, and where are we looking more towards the longer term. Just to pick a few things out from the slide, for our people and communities, it's been a lot about our Yellow Hope packages and work from home. In time, we will move towards agile working, very key for our own people. And on the commercial front, whilst we've accelerated our digital channels in the short term, we are very much excited by the opportunities for accelerated digitalization in the longer term and a renewed and sharpened focus on home connectivity. Network and supply chain, the focus has been on resilience and capacity. A lot of CapEx has gone into capacity across the networks. We've managed to secure temporary spectrum across a number of markets. We built a 12-month buffer of spares and equipment, so we are very resilient depending on how the situation plays out. But obviously, in the longer term, the focus is to resume our rollout and to resume our modernization program, and also to secure spectrum in the longer term. Also very important to manage our supply chain very tightly and very carefully in the months ahead. In terms of funding and liquidity, Ralph will take you through quite some detail on that. Suffice to say that we've built financial resilience. We've completed a lot of our refinancing activities already for the year. And the focus going forward will be around disciplined capital allocation, resuming our ARP program as conditions improve, and very much focused on reducing our US dollar debt that sits at the holdco level. So if we look at some of the trends during the first 6 months to give you a feel for how COVID impacted the business. If you look top left, subscriber gross adds, basically you can see that January, February, March was really a pre-COVID period. Significant dip in April, which is when most of the really tough lockdowns and movement restrictions took place across the markets, but a very strong rebound in May and June. Same pattern for our active data users. Weak April, strong performance in May and June. Mobile money very much accelerated also as societies moved more towards a cashless basis. Voice traffic did come under pressure and has been slightly less resilient, but we do think there's been a displacement of spend from voice into data, and you see that also in the trends for data traffic and a very, very strong increase in our fintech volumes, which I'll cover shortly. So in general, we would say that it really has the appearance of a V-shaped recovery in the shorter term, but obviously this is early stages and we still remain concerned about the longer term impacts of COVID. So these are more the commercial trends. On the next slide, if we divide it into the quarters, and firstly deal then with not subscriber gross adds, but the net adds. And there you can see a strong performance in the 6 months, over 10 million net adds, but quite some slowdown in Q2. Just remember that the churn or the disconnection of subscribers is done after 90 days of inactivity. So there is definitely a lag there in those numbers. Active data, strong performance in Q2, particularly obviously in May and June. If you remember from the previous slide, April was a tough month. Very excited by the growth in our mobile money base, especially in Q2. The pressure on voice revenue you see bottom left. Of course, we averaged out the 6 months still growing above 2%. Strong performance in data revenue. In fintech, it's obviously an interesting statistic because I've shown you how the customer growth was significant and we've shown you how the volume of transactions was significant. So the reason we have pressure on revenues is Q2 is that we put a lot of value into the market really to help our societies and our customers, things like waiving person-to-person fees to accelerate and support this move to a cashless economy. We certainly believe we're going to see a strong performance in fintech revenues still going forward. I'll now turn to the operational performance of the two large markets and the regions. So dealing first with MTN South Africa. Market context, obviously macro environment is weak. COVID itself has had a significant impact. One big theme in our results is the developments in the wholesale business in South Africa. Just to recap quickly on that, we had a contract with Telkom that came to an end in June of last year. So we had a lot of Telkom revenues in the base, nothing in the first half of this year. And we continue to account for Cell C on a cash basis. And the combination of those two events basically means that we have about R1 billion less service revenue in wholesale in South Africa in the half. And that works its way through, obviously, South African service revenue, group service revenue, and group wholesale revenue. Of course, we will very soon lap that, and that will start to work its way out of the base. Activities in South Africa, big focus on prepaid. So not only pricing, CVM, working also on data, digesting the voluntary undertakings that we did for the Competition Commission. And I think really a much improved performance. Prepaid back into growth, which I think is very encouraging. Postpaid continues to grow. Also a lot of focus on our enterprise revival. You see some of those metrics on the slide as well. And enterprise in South Africa grew very strongly in the first half. So for the first time in at least the last 2 to 3 years, we have consumer prepaid growing, consumer postpaid growing, and enterprise growing, the three customer-facing businesses. And I think that's really a testament to Godfrey and the team and all of their hard work. Another big factor was the launch of our mobile money business. Went into pilot late last year, really the commercial launch in the first month of this year. Already 1.1 million registered users in the Momo system. Please, for those based in South Africa, try it. It's the easiest way you'll find to renew your license discs for your motor vehicles under these lockdown circumstances. Also wanted to have a shout out to the SA team for the focus on efficiencies. We've seen a significant improvement in the EBITDA margin. Costs have been very tightly controlled. The margin, nudging up towards that 40% mark, and I think a very, very good performance. And also a strong performance in data. You see some of the statistics there, 77% growth in traffic on the network, strong recovery in data revenues, average reduction in the data cost per megabyte. You see it on the slide of 32%. And in the midst of all of that, still continue to score very, very well as the #1 leading BOSA network in the South African market. Let's have a look at Nigeria. Market context, I guess, similar. Some weakness in the macro environment, particularly affected there by the drop in the oil price, COVID as well. And in Nigeria, we also had an increase in value-added tax, which works its way obviously into affordability for our customers, but also into increasing some of the costs in our own business. Big focus on MTN Nigeria has been about the relative performance, making sure that we are taking our share of gross adds in the market, increasing our market share. We've seen significant gains in subscriber market share in the half, which we're very encouraged about. Big focus also on data. So that's not only 4G coverage, it's 4G devices, it's the propositions, it's the SIMs, it's smartphone penetration. And you would have seen a very strong performance in data there, You see some of it on the slide as well. Strong growth in active data customers and data revenue growth up above 55%. So, well done to the team there. Also, a lot of focus on our fintech business. Now, we all know that we've not yet secured our payment service banking license, but we do have a super agent license, and we've doubled the number of registered agents across the network. And in the 6 months, we added 1.6 million customers who've used that agent banking network for cash-to-cash transactions. So we are really using this time to build the base for our fintech strategy going forward. We also spent a lot of time in the 6 months in discussions with IHS on a renegotiation of our tower lease agreements. On the one side, we will now index part of those components to the NAFEX rate, which will increase the cost to us. But on the other side, we've secured much improved pricing for technology upgrades and fiber access. I think that will really benefit the business in the longer term. Strong focus on efficiency in Nigeria as well. Of course, we've seen pressure on the margin, a lot of that related to the movement in foreign exchange. But rest assured, underneath that, the team has done a tremendous amount of work to watch their efficiencies and their costs. If we turn to the regional review of the SIGA, WECA, and MENA regions, I think very, very encouraged by the top-line performance. So both SIGA on the one side and MENA on the other, both growing around the 20% mark, so contributing significantly to the group's overall service revenue growth. For the West African region, remember there that the average inflation is in the low single digits. So that 7% service revenue growth is a very significant performance above average inflation in the markets. And there in particular, over the last 18 months or so, we've had turnaround programs running in MTN Cameroon and MTN Ivory Coast. MTN Cameroon went firmly back into growth last year, have continued to accelerate in the first half of the year. And Ivory Coast also strongly growing in the first 6 months and starting to regain both subscriber and value market share. So well done to the team there. You also see that these 3 regions are strong contributors to the group's data revenue growth, all of them well above the 25% mark. So with that whistle-stop tour through the regions, I'll move now onto the strategic review. I think you know that we have a strategy at MTN to be a scale player in our digital and financial services businesses, as well as growing and entrenching our core connectivity business. That identifies the 6 revenue pools that we are playing in to secure our long-term growth, and I'll take you now quickly through those 6 revenue pools. So first, focusing on digital and fintech. Digital revenue across the group grew just short of 25%. That is, I think, a big milestone for us as well. The last 3 years, we've been busy with an optimization of those revenues. It's the first time we've returned to growth in a 6-month period, so that's very encouraging. A lot of effort going into Ayoba, which is really our flagship digital product, active now in 16 MTN markets. It's available over the top in the Play stores. Monthly active users around the 2 million mark, and has really been a key part of we've helped our customers and our communities deal with the COVID pandemic with lifeline data, free access to information, and very excitingly in the last few months, we've integrated mobile money into the Ayoba ecosystem. So customers now in markets like Cameroon and Ghana can do person-to-person transfers within the instant messaging ecosystem of Ayoba. On music, Music Time is now live across 7 markets, and a lot of effort there to stimulate usage and to increase our active base. On fintech, really turning now into a scale business. That's 6.1 billion rand of revenue in the first 6 months, 18% being the blended of a strong Q1 and, as I said, quite some efforts to help our customers in Q2. Some quite staggering results if you look at the activity across the fintech ecosystem. In the first 6 months of 2020, the transaction value across the MTN fintech ecosystem was $61 billion and 11,752 transactions per minute, which is up 28% on the equivalent period of last year. A lot of focus also on our move into advanced services. We have 8.6 million registered insurance policies in our IO joint venture, launching Momo Advance and Marketplace in 2 of the markets. And again, as we said there, a lot of support for customers in the fintech business. Turning to enterprise and wholesale, really wanted to spend a few minutes on enterprise. In the first 6 months of the year, 7.9 billion rand of service revenue. This is really also a scale business for the group. It's an area where we have generally relatively low market shares, and we believe that there's a lot of potential there as well. Service revenue growing 14.2%, significantly aided now by the turnaround in South Africa. We have double-digit growth in all of our key markets. Of course, it's been stimulated a little bit by our enterprise customers encouraging work from home and remote working for their people. And one of our key focus areas going forward, now that we've stabilized and grown the core connectivity part of enterprise, is a much more deliberate push into enterprise services. These are things like unified communications, cloud, IoT, and of course, managed network services and SD-WAN, which are really, high growth areas across the market. Wholesale, remember here that minus 31%, of course, is including that 1 billion rand reduction in wholesale revenues in MTN South Africa. Underneath that, of course, there are all of the wholesale revenues of MTN Global Connect, which is our infrastructure company we've set up in Dubai. That had a very strong performance, 43% increase in revenue, a lot more interconnect partnerships struck, and also very excited by MTN's participation in the 2 Africa submarine cable project. Finally, looking at voice and data. Voice still the most significant contributor to group service revenue, 44.5 billion of revenue. It's about 55% of the total, still growing 2.6% in the half despite the pressures. Very important to remember with voice that one of the key drivers there is subscriber growth or base growth. That's why we still remain positive about growing this category in the medium term. And we added 10.6 million subs in the first 6 months, now at 261 million, just over. A key part also of stimulating voice revenue are our CVM initiatives, customer value management. And that's a lot of private pricing at an individual customer level to stimulate small additional amounts of revenue with increased minutes. That is alone contributing 3% to revenue. And on average, across the whole portfolio, minutes of use increased by 6%. So still a lot of elasticity in our core voice product. If I look at data, I think, really encouraged by the scaling of that business. We crossed the very important mark of more than 100 million of our customers now active data customers. I think if anybody follows cricket, we would have lifted our bat sometime in the middle of July when we reached the 100 million mark. 6.5 million active data net adds in the 6 months. Continue to expand coverage, 3G, 4G. Very important also that we continue our price transformation across the markets. And you can see that across the whole portfolio, the effective rate per gigabyte decreased by 34%. So a lot more value for customers there. Of course, we can still grow those revenues strongly with data traffic growth of around 91%. And also very encouraging to see smartphone penetration across the markets nudging up against that 50% mark. Then, of course, to deal with the announcements today around portfolio review and the asset realization program. In terms of the portfolio, we've taken a decision that we will in future be focusing our energy and efforts on our Pan-African strategy. This is, of course, close to home for the group. It's where, the vast bulk of our earnings and EBITDA come from. This means that we will, over the medium term and in an orderly manner, exit our Middle Eastern assets. They contribute circa 3% or so of group EBITDA at this stage, so a relatively modest contribution. Of course, those environments have become increasingly complex over the last while, and we believe this will simplify the portfolio and enable a much sharper focus on the Pan-African strategy. And as the first part of this shift in portfolio, we announced that we are in advanced discussions to sell our 75% stake in MTN Syria. We hope to conclude that over the months ahead. Second part of the slide is around the optimization and asset realization program. I think we know that we realized the ATC Ghana and Uganda JV, so 8.8 billion of proceeds came into the group. On the advanced services in fintech, we're also announcing that we are increasing our shareholding in IO to 75%. That is the insurance joint venture I referred to earlier. On Jumia, we've seen a significant increase in the Jumia share price in the last while. The group's investment in Jumia at the last valuations is around 4.5 billion rand, and we will be looking at moving forward with that in the months ahead, and we have our regulatory filings in place to facilitate a sale there. And finally, we are also announcing that we are in advanced discussions on the disposal of our 20% shareholding in BICS, the carrier company, and that has a holding value in the group of around 2.3 billion. So, it's good to get the JVs behind us. It looks like we can still make progress, ideally on BICS and potentially Jumia. For the rest of the program, it's definitely been slowed down by the volatility in the capital markets, but we are using this time to make sure that we are fully prepared as and when markets improve. So with that, I will hand you over to Ralph for the financial review. Thank you.
Rob, thanks very much, and very good morning to everybody joining us virtually on various media platforms. Special greetings to all the MTNers across our markets who've also joined into this results announcement. We are in unprecedented times with COVID having significant health, social, and economic impacts in our markets. Rob and I deliver these results conscious and cognizant of these impacts and the essential role that MTN Group plays across our markets to provide reliable connectivity and digital services to our customers and businesses in all the markets we operate in during these difficult times. So over the next 30 minutes, as part of the financial review, I'll take you through the following. Firstly, I'll cover the material items impacting reported results. Then, given COVID-19 impacts and the lockdown we experienced, particularly in Q2, I will highlight the key service revenue trends to build on to the trends that Rob showed earlier. I'll then cover salient points on the group income statement. A review of our two largest markets, South Africa and Nigeria, will follow. And then I will return to the income statement for a detailed review of select items. Finally, I'll conclude with a balance sheet, cash flow statement, returns, and then progress on our medium-term guidance. There are four material items impacting our reported results that I would like to highlight. Firstly, currency movements. The weaker average rand against the basket of currencies across our consolidated subsidiaries resulted in reported results being higher than constant currency trends. The average rand was weaker against the naira by 10.9% and weaker against the cedi by 8.1%. The weaker closing rate for the rand against the US dollar impacted balance sheet items and our holdco leverage negatively. The rand closing rate was 19.6% weaker than at the end of 2019. As a consequence, the share of US dollar debt in the holdco debt mix increased to 52.3% at the end of the period. Foreign exchange gains of 852 million were recorded, driven principally by the revaluation of group loans and receivables denominated in hard currencies. Significant transactions were the second material items, and there are two transactions to note. The ATC JV tower companies were classified as non-current assets available for sale at the end of 2019. The transaction closed in Q1 of this year, and the group received proceeds in dollar terms of 8.8 billion rand, and we recorded a profit on disposal of 6.1 billion rand. MTN Syria has been classified as held for sale, given the portfolio review done in the Middle East and the advanced discussions we're in to dispose of our 75% stake in that business. The net assets attributable to Syria have been written down to the estimated recoverable amount of 1.4 billion. We recognized an impairment loss of just under 800 million on the remeasurement of this asset. The third material impact to note was a change in accounting policy. The group reviewed its accounting policy on calculating the foreign currency translation reserves that recycle on disposal of a foreign entity. The group implemented a voluntary accounting policy change related to the release of these reserves and has changed from a step-by-step method to a direct method. The details of these changes are included in our interim financial statements, under note 22.1 for those who would like to look. The total impact of the restatement on historic transaction is an increase in foreign currency translation reserves released to retained income of 2.1 billion as at the start of 2019, which relates to historical disposals such as the sale of MTN Cyprus and INT Towers. For the current and comparative period, the impact of this change in policy is an increase in EPS of 47 cents per share for the first half of this year and 7 cents per share for the first half of last year. The policy change has no impact on headline earnings per share in the current or prior periods. Lastly, COVID-19 related impacts. As our retail customers, enterprise and distribution partners were impacted by the pandemic, we saw an increase of 732 million in the provision for doubtful debts to a total of 3.8 billion at the end of the period. In the period, we also recorded impairments of 228 million for MEIH, our Middle East e-commerce business, 308 million for Liberia, and 165 million for Guinea-Bissau, all driven principally by COVID-19 impacts. Before I go into the actual reported results, let me illustrate the trend of the 6 revenue curves at a group level in the 6-month period. In the chart that you see, we have indexed the trends to 100 for January 2020, and the evolution is on a constant currency basis. I would like to highlight a few items on this slide. Firstly, voice was materially impacted by the lockdowns during April and early May. And as a reminder, voice makes up 55% of group total service revenue. The key impacts on voice trends were low levels of electronic recharging across some of our key markets, in particular Nigeria, and the observance of the holy month of Ramadan during April and early May, where we seasonally get lower voice traffic. Secondly, on data, we experienced a surge in traffic due to work from home and learn from home arrangements, and traffic patterns have remained fairly resilient since the surge we saw in March. On fintech, the revenue profile was affected by the reduction in transaction fees that Rob spoke about, we made as part of the Yellow Hope initiative, and where authorities encourage citizens to embrace cashless transactions as part of mitigating COVID-19 risks. Finally, the trend in wholesale was driven by the national roaming in South Africa, where we continue to account for Cell C revenues on a cash basis. Looking at reported results, let's start with the salient points on the group income statement. On the right-hand side of this table, we show the growth rates of some of the income statement items on both a reported and constant currency basis. We had solid constant currency service revenue growth of 9.4% in the period, led by double-digit growth from Nigeria and Ghana. South Africa declined by 2.5% due to the ongoing effects of its wholesale business. In quarter 2, the South African service revenue result was strong, with a sequential quarter-on-quarter growth of 6.4%. Excluding once-off items, you can see that on a constant currency basis, EBITDA grew by 10.9%, and reported EBITDA increased by 21%. The increase in depreciation, amortization, and goodwill impairment was largely driven by increased network capex additions in prior periods. As I mentioned, we also had impairments recorded in the period for MEIH, Liberia, and Guinea-Bissau. As you move down the income statement, you can see a positive swing on the JVs and associate line. The swing is driven primarily by the discontinuation of Jumia as an associate, and after Mascom was reclassified from held for disposal at the half year of last year, it's now back as an associate in the current period. Further down, you'll see a noticeable change in the income tax expense line. The group effective tax rate for the period was 26.7%. This was positively impacted by the non-taxable gains on the disposal of the ATC tower companies. Adjusted headline earnings per share, our measure of underlying operational earnings momentum, increased by almost 54% in the period, and this was impacted positively by the adjustment of non-operational items totaling 46 cents per share. And as Rob has mentioned, the board found it appropriate to not declare an interim dividend given the ongoing uncertainties brought on by COVID-19 across our operating environments. Let us now have a look at the financial performance of our 2 largest markets, starting with South Africa. This slide illustrates trends in service revenue, expenses, EBITDA, and CapEx in the period under review. Service revenue declined by 2.5%, impacted by the reduction in national roaming revenue in the period and base effects where we had both Telkom and Cell C revenue in the first half of last year. We have unrecognized Cell C revenue of 673 million at the end of the period. Excluding wholesale, service revenue increased by 2.3%. The release of a loyalty provision as a result of our change in the loyalty catalogue and a review of the new breakage assumptions impacted the reported service revenue positively by 0.6%. Let us now have a look at the performance at the revenue bearer level. Outgoing voice was down 6.5% year-on-year. This was driven mainly by reductions in the effective tariff, which declined 15%, while traffic was up 9.5% year-on-year. Data revenue was up 16.7%, supported by a 77% increase in traffic and an increase of 14% in active data subscribers, which now total just over 14 million. Average data usage was up 63% to 2.6 gigabytes per active data subscriber. The effective rate dropped by 32.6%, partially impacted in Q2 by the reductions in data pricing in line with the voluntary undertakings we signed with the Competition Commission. Core digital revenue declined 10.3% as customers prioritized the spend on data rather than content services. However, the digital business began to show a return to growth in the last 2 months, ending the quarter down 3.6%. Fintech revenue, which comprises of airtime lending fees, declined by 1.2% in the period as MTN SA took a prudent view on airtime lending in light of the current macro conditions. And the wholesale revenue declined by 41.4%, driven by the dynamics I mentioned earlier on Cell C and Telkom in the base. While still looking at service revenue, here's a bridge view of the contribution of each of the segments within the South African business. A few comments to make on this slide. Encouragingly, the consumer prepaid business was up 1.7% in the half, increasing by 3.5% in Q2. This was achieved by strong commercial execution in CVM and changes to commission structures. We are seeing early elasticity effects on prepaid data, which grew by 14% in the period. The consumer postpaid business delivered service revenue growth of 3.1% in a highly competitive environment. We continue to strengthen credit vetting processes to support sustainable growth. The growth we experienced in the half was driven by good customer take-up of our MTN SA mega deal offers. The enterprise service revenue was up a very strong 15.1%. The business benefited from interventions aimed at stabilizing churn, adding new corporate customers, as well as the uptake of work-from-home solutions. This was further boosted by sales of data deals customized for universities in order to facilitate online learning. If we excluded the university deals, the enterprise service revenue growth would have been still a very strong 13.7%. Then back to expenses, margin, and CapEx in South Africa. You can see that the cost of sales was significantly lower by 18.1%, impacted by the reduced device distribution during the lockdown, with improved gross margins on devices as well as lower commissions. Device cost of sales declined by 27% as device volumes were down almost 25% on year. The average cost per device was also down by 3.1%, with average revenue just under 8%, supporting improved device margin in the period. Commission expenses were down 17% year-on-year. Prepaid commissions were lower by 20.5%, driven by changes we've made in the period. And we also saw a mix effect from logical to virtual that was positive for commission expenses. Postpaid commissions were lower on reduced commissionable connections due to the lockdown impact. OPEX was up a slight 0.5%, driven by a focus on efficiencies. Network and IT OPEX was relatively flat, positively impacted by vendor credits of 60 million rand received during the period. We also had lower marketing expense driven by the lockdown impacts, and staff expenses were well managed and lower by 2% on the period. Within OPEX, we had lower share-based payments provisions within staff expenses and doubtful debts were up to 562, given expected credit losses as a result of COVID-19. As Rob mentioned, the EBITDA margin was up a healthy 3.4% to 39.9%, driven by good expense management, the release of the loyalty provision, vendor credits, and lowered device cost of sales. The constraints presented by COVID-19 to rolling out our networks, along with an increased focus on efficiencies, resulted in a capex intensity of 16.7%. Moving on to Nigeria, many of you will have seen the results reported last week, so I will focus only on the salient points. We recorded a solid 12.4% growth in service revenue. The core voice market grew 2.5% in the half, impacted in Q2 by the lockdown arrangements, as well as lower voice traffic during the holy month of Ramadan in April and May. Since May, we have seen a recovery in voice traffic, but the voice revenue profile by the end of June was still below the March 2020 peak. Solid data revenue growth of just under 58% was driven by a strong increase in active data subscribers of 4 million to a total of 29 million. Data traffic rose by just over 41% year on year. MTN Nigeria added 4 million new smartphone users to its network, bringing the smartphone penetration to just under 44% of the base. We recorded a strong growth of 123% in digital revenue in the half. The work done to expand the user base yielded positive results. Active digital subscription increased to 1.6 million in the half. Our revised portfolio of digital offerings and improvements in the customer experience supported this growth. The fintech revenue had good growth of just over 29%, driven by airtime lending. The progress on expanding the agent network in Nigeria is ongoing, as Rob mentioned, with the total number of registered agents rising to 222,000 in the half. In terms of expenses, these were up 18.8% year on year. Cost of sales growth was driven by high commission and distribution costs, which were up 14.6%, and national interconnect, which was up 7.4%. OPEX increased 26.4%, impacted by the high costs associated with an aggressive 4G site rollout and higher site rental costs, given the Naira exchange rate depreciation against the US dollar at the end of Q1. In addition, effective Q2, the reference rate for conversions to Naira on the IHS contract moved from CBN rate to the NAFEX rate. All of these led to a reduction in margins of 2.1 percentage points. Non-recoverable VAT on lease payments also impacted margins negatively by 0.2 percentage points. The unanticipated COVID-19 costs incurred impacted margins by 0.3 percentage points. We also raised additional provisions for doubtful debt in the period, and these reduced margins by a further 0.3%. MTN Nigeria continues to implement expense efficiency initiatives aimed at restoring margins in the near term, supported by the revised IHS deal signed recently. And as you can see, total capex expenditure was 5.9 billion rand for the period, and we achieved a capex intensity of 20.8%. So now coming back to the group income statement, what do we see on service revenue? Voice, data, and fintech were the key drivers of growth in the period. Voice revenues grew 2.6%. Voice came under pressure from COVID-19 related lockdown arrangements in the early part of Q2, but as I mentioned before, we've seen a recovery from May and into June. Data revenue grew 32.7%, driven by a surge in data traffic of just under 92%. The active data subscriber base grew by 6.5 million to close at just on 102 million. Digital revenue increased by 24.6%, supported by an improved take-up of our digital offerings and base effects of the vast optimization that we concluded last year across our various markets. Fintech grew 18%, driven by base growth of 3.6 million in our mobile money business. And as Rob mentioned, the insurance business now has approximately 8.6 million policies and is expected to contribute to the fintech growth in the future. We are in the process of increasing our share of the insurance JV we have with MMH from 50% to 75%, as we see opportunities to further scale in insurance across our markets. Wholesale revenues declined 30.7% due to the national roaming effects mentioned earlier. And the progress to scale MTN Global Connect is ongoing, and we saw very strong financial performance with revenue growth of 43%. Moving on to EBITDA. On this slide, you'll see both the drivers of group EBITDA in absolute terms and in terms of the impact on the group margin. Overall group margin was up 10.9% on a constant currency basis. The growth was broad-based, led by the performance of Nigeria and the SIGA and WECA markets. At an operational level, the EBITDA margin expanded 1.2 percentage points, with positive contribution coming from all markets, save for MTN Nigeria. The turnaround in the WECA region during the period was particularly encouraging. We had a stronger H1 from a service revenue perspective with growth of 7% versus the 0.5% we had year-on-year in the prior period. The turnaround in supporting margin improvement and contribution to the group is very pleasing, and well done to Carl and the team. The group EBITDA margin improved year-on-year to 49.7%, supported by the gain on disposal of the ATC joint venture tower companies. Let us now have a look at finance costs and leverage. Starting with finance cost. The increase in net interest paid was a result of additional bank debt that MTN Nigeria took onto its balance sheet of approximately 8 billion rand. And this is in line with its plan to optimize its capital structure. Interest expense for lease liabilities also increased in the period, driven mainly by Nigeria and Ghana. Net forex gains were recorded at the head office, driven most notably by 2.2 billion on the MTN Netherlands loan and 402 million on the Iran receivable. The gains were partially offset by losses in South Africa, which increased due to financial guarantee provisions, and South Sudan, which increased due to a higher rate of settlement of foreign denominated creditor balances. As you can see, the average cost of debt increased slightly to 9.8%, driven by the swing in forex losses prior period to current. And then moving on to leverage, at 1.1 times, the group leverage improved and benchmarks well against emerging market peers. The increase in the group interest-bearing liabilities was largely driven by the new bank debt in Nigeria. The holdco leverage, which is part of our guidance, increased to 2.7 times, impacted by the weaker rand and lower upstreaming from operating companies. The rate of upstreaming has been slower than usual in most markets, although some progress was made in the half, with 4.9 billion rand upstreamed to the holdco. Cash upstreaming from Nigeria was challenging. The dividend declared in Nigeria in 2020, both the full year 2019 as well as the half year 2020, both are still to be repatriated, are of about 5.8 billion rand at current exchange rates. Let us now have a look at the statement of financial position. Included in other non-current assets is our investment in IHS, which we fair valued at 30.7 billion rand at the end of the period. The fair value of IHS is calculated using an earnings multiple technique based on adjusted tower industry earnings multiples of between 9 times to 12 times, applied to our estimate of IHS earnings, less estimated net debt of 30.6 billion rand. In addition, we applied a 30% discount in determining the fair value, given current market conditions as of the end of the period. Total mobile money deposits and payables recognized at the end of the period amounted to 24 billion, and these were principally driven by Ghana, which had a 5 billion increase in Momo deposits. The increase in other current assets is due to additional investments in fixed deposits made by MTN Nigeria and MTN Mauritius. Looking further down the table, there is an increase in non-current assets held for sale as a result of the Syria operation being classified as held for sale as of the end of June. And interest-bearing liabilities increased by 19.8%, mainly as a result of the new bank debt in Nigeria. This was also impacted by the depreciation of the rand on US dollar denominated loans. Moving on to CapEx, the slide shows further improvement in our CapEx intensity in line with our medium-term guidance. We remain focused on increasing the capacity of our networks, although the effects of the lockdown restrictions have delayed some of the site rollout plans. We capitalized just over 10 billion rand in the period, which is lower than in the first half of last year. We rolled out a total of 1,400 3G sites and 2,600 4G sites in the period. And as you can see, RAN and transmission accounted for 2/3 of total CapEx, and we continue to invest in the modernization of our IT systems. Although the focus for CapEx rollout is on 3G and 4G deployments, we're ensuring that in key markets, future RAN and transmission deployments will make our networks 5G ready. MTN SA launched its 5G network with 100 sites live in Johannesburg, Cape Town, Bloemfontein, and Port Elizabeth. The launch is the culmination of extensive 5G trials and testing and was enabled by the allocation of temporary spectrum from ICASA. In South Africa, the multi-year modernization of the network is progressing as modernizations in other markets have commenced to ensure our networks are resilient and 5G ready. We have reforecasted CapEx for 2020, and based on better visibility of supply chains, current lockdown arrangements, and exchange rates, we see capitalization of 24 billion for the full year. Looking at the net debt profile and liquidity, there are a couple of points I would like to highlight. On the left-hand side of the chart, you can see the trend view of group and holdco leverage. Our medium-term focus remains to reduce our exposure to US dollar debt and improve the funding mix at the holdco level. As part of our capital management framework, we have clear actions we are executing to reduce holdco net debt further and to ensure that our debt profile is appropriate and resilient to reasonable stress scenarios for currencies and upstreaming risks. Growth in earnings and cash flow remain the most important action. This will be supported by executing on our enhanced asset realization program of at least a further 25 billion over the medium term, and managing our CapEx within an appropriate envelope of approximately 28 billion rand per annum in the medium term. Execution of our 2020 refinancing priorities has progressed very well, and we have to date executed on the 15 billion of funding since the beginning of the year to deal with the debt maturities in the 15-month period ending 31 March 2021. This is a pleasing outcome given the uncertainties presented by COVID-19 on our debt capital markets. On liquidity, we have a very healthy position, which has improved since the end of 2019. At the end of June, we had cash of 15.7 billion at the holdco level and access to undrawn committed facilities of 25.1 billion rand. Moving on to cash flow, let me take you through some of the key drivers from EBITDA to free cash flow development. In the half, we saw 5.6 billion working capital outflows. Nigeria contributed 600 million, mainly as a result of BTS prepayments made towards IHS. Sudan made a payment of 700 million for prepayments made for future CapEx and OpEx. Congo B had an additional 600 million in interconnect receivables. The head office also had an outflow of 500 million, driven by an increase in withholding taxes receivable from the operations, as well as realized forex on sundry debtors. We had cash CapEx of 13 billion as we built out our networks and delivered growth in operating cash flow of just under 118% in the period. Financing activities of 2.3 billion rand were principally driven by the additional debt raised in Nigeria, offset by settlement of borrowings. This was also impacted by the capital portion of leases, which is included in financing activities of 3.2 billion rand. Other investments of 0.3 billion rand were driven by proceeds from the disposals of the tower companies, and these were offset by additional investments of 8.2 billion rand in fixed deposits by Nigeria and MTN Mauritius. Now let us have a look at progress we've made on ROE. The chart shows a bridge view on the drivers of our return on equity. And here we can see that ROE increased from 12.8% to 14.1%, driven by operational earnings growth from the consolidated subsidiaries, with the most significant contributions being Nigeria, SIGA, and WECA. As you look at the bridge view on ROE development, the operating result was a strong 17.1% in the period. The non-operational impacts reduced the reported result by 3%, driven principally by movements in NCI and foreign currency translation reserves as a result of the weaker rand on the reported results. In the period, there were no material impacts coming from the asset realization program, which we anticipate that in the medium term will contribute meaningfully to the return improvement as we unlock value through the disposal of tower company and e-commerce investments. So let me conclude my presentation by looking at how we've performed against our medium-term guidance. And there are a few points I would like to highlight that are on this chart. On group service revenue at 9.4% constant currency, we're slightly under the guidance, with voice across our markets being the most impacted by COVID-19. South Africa growth was below guidance at minus 2.5%. Just to note, this was due to the impact of national roaming as mentioned earlier. And if we adjust for these effects, underlying growth would have been plus 2.3% in the half, with an acceleration of 4.3% growth in quarter two. And this is closer to our mid-single-digit growth ambitions for South Africa, underscoring the progress in the underlying consumer enterprise business units that we've seen in the period. EBITDA margins expanded 1.2%, as I mentioned earlier, driven by operating leverage and progress with our expense efficiency program. CapEx intensity remains within guidance, but we will see an acceleration in the second half where we anticipate a further 14 billion rand, mostly in network investments in capacity and resilience. At 2.7 times, the holdco leverage is below guidance, impacted by the cash upstreaming and a weaker rand. No ARP disposals were done in the second quarter, but we're encouraged by the discussions of BICS that Rob referred to earlier, where BICS has a carrying value of 2.3 billion rand as the end of June. And on ROE, operational progress has been strong, and we remain on track to deliver on this guidance. Ladies and gentlemen, that concludes my presentation of the financial review, and I will hand over back to Rob.
Thank you, Ralph. Hope you found that useful to go through all the detail of the numbers. Looking ahead, just really have 3 slides to cover. I think the first we wanted to tackle is to return to the COVID-19 theme. And what you see on the slide in front of you is the 6 key dimensions that MTN has been making its contribution to helping our countries, our customers and communities deal with the pandemic. We've aggregated the value of all of the zero rating of sites, free SMS, the work we've done in our fintech business, and there is circa 1.8 billion rand of value that the MTN opcos have contributed across the markets. The 6 key dimensions of our Yellow Hope strategy is really obviously looking after our customers, as we've discussed, governments and partners, schools and universities to enable e-learning and e-education, largely through the zero rating of educational sites, support for government funds across the markets. Particularly in the foundations, we focused our efforts on supporting the health system, enabling health workers, as you saw in the video a bit earlier, and increasingly also playing our part in the growing issue around food security. I guess the point we wanted to make is, much as we've lived through a difficult time with COVID, we still believe it is going to be a big theme through the rest of the year and going into the future as well, as we start to rebuild the economies as the pandemic wanes. And it's very important as MTN, and we're very focused on sustaining these efforts and playing our part going forward. Second slide is really just to reinforce our investment case and our business model. I think if you look at the performance in the first half of 2020, if you look particularly in Q2, you see the resilience of the business model. We believe that it is validating what we set out as the investment case in the last while. We have a strong position in the right markets, large, high-growth markets, always a number 1 or number 2 operator, meaning we've got scale and presence and infrastructure and resource. We still are believers in the demographic opportunity driving revenue. So that is a combination of fast-growing populations that is driving subscriber growth, relatively low levels of adoption of data, digital, and fintech. And you see in the COVID pandemic an acceleration even of that adoption. And also very excited again about the opportunities in enterprise and wholesale and really believe that these also will be scale businesses going forward. When it comes to return profile, we've always communicated that we really see two types of operating leverage in the business. With demographics driving revenue growth, the first layer of operational leverage is that we can use our scale and improve our efficiencies to improve margins. And that basically means that profits would grow ahead of revenue. And secondly, our smart CapEx program, CapEx costs coming down, means that we can stabilize our CapEx at its current absolute levels, which means, of course, then that cash flow would grow faster than profit. And this theme is very strong, I think, in these results. If you look at top line growth 9.4, adjusted HEPS growth at 54, free cash flow growth over 100%. So I think it is really validating our investment case. And finally, we believe we're well positioned for the long term. The portfolio optimization is going to give us a big opportunity, obviously, to deal with the holdco debt, which is a big focus of ours. Leverage is still sustainable. To have a multinational telco with a group net to debt ratio of 1.1, is less than half of what you see around the world. And we are still believers in our progressive dividend policy, despite the fact that we suspended for the interim. And as I said, we will look at that in the final year as well. And in the middle, of course, we have our strategy, the 6 pillars of Bright, which I think has driven a lot of the operational execution in the half. So finally, then, to deal with our priorities for the remainder of the year. So this is the framework we put up in March 2020 when we announced the final results. It really has, I guess, 3 dimensions on each axis. The first key dimension in the first row is the focus on growth. We still very much see ourselves as a growth company, and we believe that we need to build out to scale our digital and fintech businesses, but at the same time to build out on that core connectivity business. You see some of the focus areas there, which we've discussed already. Build a subscriber base, data adoption, a renewed focus on home connectivity, enterprise services. In digital, scaling up our Ayoba platform and building that platform. And of course, in fintech, to scale up our 2 large markets, accelerate the advanced services, and also accelerate the transition of our customers from USSD on basic phones to the full functionality of our Momo app, as you will see, obviously, in the South African market. But the second key dimension also is efficiency, and it is a very strong because we believe that the future for MTN is to have all of the attributes of a high-growth emerging market telco and digital player, but at the same time to have the rigid and strong cost discipline that you see in more of the developed markets. And so the efficiency agenda is a main program of the group, and you're starting to see it bearing fruit if you look at the improvements in margin. It is a combination of digital transformation within the company, so agile working for our own people, to digitalize our key customer journeys that also will save cost and improve the customer experience. Technology evolution, we need to continue in time with the rollout and the modernization, which is also much more efficient. And then, of course, on the OpEx side, our cost transformation program, strong focus on cost control measures, and the group efficiency program, which is already well in execution. The final dimension is the work we're doing on the corporate front. So we've discussed our Pan-African focus. We've taken you through the prospects for the asset realization program, the groundwork that's being laid. We will continue to participate in the opportunity in Ethiopia in the privatization program. On the risk and regulatory front, clearly managing COVID is a big risk that needs to be properly managed. We are also putting a lot more effort and resource into our fintech business. That's resourcing, systems, infrastructure, particularly as we transition to more of the advanced services. And we will continue to manage some of the more complex litigation matters we have. Finally, on the broader topic of sustainability, management succession will be a key focus in the second half of the year, as I'm sure you're aware. We also believe that the ESG strategy of MTN is very critical. We've got a very good story in terms of our contribution to things like digital inclusion, financial inclusion, but we do need to make sure that we also have all of our processes and policies in place, that we have the right disclosure, so that we can reveal to investors that are strongly focused on ESG all the good work that's being done within MTN on issues of environment, social, and of course broader governance. And we have a very, very deliberate program there, and absolutely committed to improving our disclosure and our adjudication on ESG on matters going forward. And finally, of course, as I've said, we will continue to play a very significant role in helping our countries, customers, and communities deal with the COVID-19 pandemic. So we thank you for your attention. I'll ask Ralph to join me on the stage. We are very, very far apart on our two lecterns to maintain our social distancing. We've got some time for Q&A. I think we have questions coming in both on the webcast and perhaps one or two coming in on Twitter. And Tato has been managing that, Nompilo as well, I think. So you will be, I guess, the representatives of our important stakeholders asking questions. And I must say I'm delighted that the first question will not be coming from JP Davids, who is now at Vodacom, unless he wants to ask us why our network is so much better than his, which we'd be happy to deal with. Tato.
Thank you very much, Rob. We've got a few questions on the webcast. I'll ask them in banks of three. The first one, which has a couple of parts to it, from Jonathan Kennedy-Good of Standard Bank. He's just looking for clarity on the decision to potentially pay a final dividend. Given where the net debt level is and the progress on asset sales, would it not be more prudent to pursue a more rapid debt reduction than to pay further dividends? Linked to that, is there an impact on the Zakhele Futhi scheme in terms of skipping the interim dividend? And then another question linked to that, how do you get to the 390 in terms of the maximum for the full year dividend, final dividend? The second question.
That sounded like three already.
That was three questions.
Do you have a finance degree?
I'll ask the fourth question.
Okay, well, I'm writing them down.
Relates to the exit of the Middle East. Does it include MTN Irancell? And what is the timing around those disposals, or those exits rather?
Okay, so perhaps I'll deal with the first part of Jonathan, and then Ralph, you can do Zakhele and 390, and then I'll come back on the Middle East. I think the dividend is a complex question. You know, as I said earlier, the group leverage is very conservative at 1.1 times. I mean, it's less than half of the covenants we've got. The operational performance, the cash flow generation for the group is strong. We have two challenges in the holdco net debt ratio. The one is that there's about $2 billion of debt there that is translating at a much weaker rate of the rand to the dollar. I mean, that could get worse, it could improve. It's very volatile. And the second challenge is that we've got some delays in upstreaming, coming out of the larger markets. And so, we really wanted to keep the flexibility open that if, towards the end of the year, we see things going in the right direction, perhaps the rand eases off a bit, we make some progress in upstreaming, perhaps we can execute some of these asset realization programs, then, there would be no reason, to not move forward with the dividend. And I guess the second point is just to remind investors that we are targeting 25 billion rands worth of asset disposals over the medium term. I mean, that is, broadly enough to extinguish virtually the entire US dollar debt. And so, we really believe we must strike the right balance between, continuing to reward shareholders in terms of dividends, and there are many investors who are focused on the dividend, whilst at the same time, remaining true to our capital allocation priorities. And you see that in the half that, we've really moved a lot, to up the investment in the network. So it's an uncertain time. We're going to keep our flexibility, but, rest assured that it'll be well thought through and responsibly taken early in the next year. Ralph?
Yeah, I mean, maybe just to build on to Rob's comments, Jonathan, I mean, we have set out pretty much in batting order how we see the capital allocation framework, which is, invest in your network as priority number one. And we said in the medium term, we see about 28 billion per annum. So that still remains in place. The second actually is debt reduction, and then the dividend, returns to shareholders as number three. So it's a balancing act between those. And as we've thought about, the communication on passing the final dividend and how we're thinking about, passing the interim dividend and how we think about the final dividend, they're basically excluding COVID impacts, three items that are important. The first is upstreaming. As I mentioned in my presentation, we have about between the prior year final dividend and the H1 dividend out of Nigeria, current exchange rate is just on 5.8 billion rand. And so we want to see progress on that, as a company and as a board. The other is progress on on the asset realization program, and we've got BICS underway. As we said, it's still a work in progress, but you well remember that the other ones are IHS and further localization in Nigeria. So the enhanced ARP is the second area, and then that will then impact also the holdco leverage, seeing where exchange rates will be. So those will be the three main items that the board will apply its mind on in assessing, when or if we pay the final dividend. On the 390, the maths there is fairly simple, Jonathan. We basically, as Rob said, we're maintaining the guidance, and that's a 10% growth on the prior year final dividend. That's how we get to the 390. You know our dividend policy's growth of between 10 to 20%, and that's a 10% growth on the period.
Then I think, Ralph, there was a question on Zakhele Futhi.
Yeah, on Zakhele Futhi, Zakhele Futhi has been impacted, and the amount that they need is de minimis. It's about 15 million rand. They have pref share servicing costs of about 24 million, and so that they will service in September. And then there's 15 million of working capital that they require. So that's the amount, and we've agreed between ourselves and Zakhele Futhi board on the 15 million rand loan.
Thanks, Ralph. I'll pick up the question on the Middle East. So we essentially have four assets in the Middle East. We have 3 subsidiary companies in Syria, Yemen, and Afghanistan, and then we have our 49% investment in MTN Irancell. Certainly the focus in phase 1 is to focus on the consolidated subsidiaries, the 3 that I've just described. For the investment in MTN Irancell, obviously that's a material investment. Like any investment, you would like to see it generating a yield. You would like to see it increasing in value. And there, I think, although over time we will see a full exit, that is definitely one that we will, take our time and make sure that, we can work with our partners there and generate, full value for the group. Tato, can we take the next batch?
Okay, I'll take.
There
are questions from Prince from Global Markets. He's asking about plans around Nigeria dividend repatriation given liquidity challenges. That's one question. Another one comes from Dilawa. They're asking if you can expand on the cash repatriation from Nigeria still. Have you had any guidance from the Nigerian government central bank around how much of the 5.8 billion you can expect to upstream this year? And the last one is from Alistair from New Street Research. Could you please break down the 4.9 billion repatriations received during this period? So they all relate.
Sounds like all my questions, Rob.
We're in your capable hands.
Yeah, look, I guess everybody understands that given the COVID-19 impacts where oil has been both price and production and volume effects, it has had quite a challenging impact on Nigeria. So, to the point is that the full year dividend from last year, circa 190 million equivalent, and then the H1 2020 dividend that was declared last week, it's another 147 odds that approximate the 5.8 billion. Right now as we sit, there are no, dollar availability in Nigeria is difficult. We haven't been able to upstream. We can't give you a time and certainty on when we'll be able to. Suffice to say that, we're engaging our banks that we work with in Nigeria, engaging the CBN in putting our letters for prioritization of dollars, and we'll see how that plays out. You guys read the news as much as we do, and there's an understanding that once the IMF loan has come in, the borders get opened, flights start moving, which is in the next couple of months, is the assumption that the liquidity will improve, and then we'll be able to get. What we do understand, though, is that the Central Bank of Nigeria wants an orderly movement or depreciation of the naira, and in between that, I think there may be some market risk that we'll face, but right now we don't have any certainty around that. And then on the breakup of the 4.9, I don't think we normally try to disclose country by country, But suffice to say that, between the SIGA and some of the WECA markets is where we're getting that upstreaming coming through.
Okay, the next bank of questions would be the last bank of questions. The first one from Patrice of Visio. He says, thanks for the presentation, well done in a difficult environment. One question is on the unrecognized accrual of the 673. Is there a cost to MTN for carrying the Cell C traffic? And is there some traffic from MTN that is on the Cell C network that MTN pays for? The next question from Warren Riley of Bateleur. Has there been any updates on the Nigerian PSB license, and what are your expectations? And just on the South African costs, can you comment on the sustainability of some of the cost savings into the second half?
Okay, maybe I'll kick off on the first couple, and Ralph, you can build and then take number 3. I think important to say on the Cell C accounting that although we record the revenue on a cash basis, obviously whatever costs there are accrued and processed in the books of account. So there's no doubt that additional money when it comes in would be almost pure margin. Simple math, if you add 700 million of EBITDA and you put it into the revenue as well on 21.1, it would have added about 3% onto the EBITDA margin. So it's a significant factor, and we certainly look forward to some more stability in Cell C as they proceed with their recapitalization. Second part of the question, no, not yet. We don't yet have MTN customer traffic on the Cell C network. On the Payment Service Bank, our application was submitted, 18 months ago. The central bank approved 3 approvals in principle for the Payment Service Banking license. Those have not yet been translated into formal approval, so nobody is active yet in that category. I'm sure we appreciate, the tremendous pressure on the CBN, dealing themselves with the whole COVID situation. So we are being patient, we're continuing to build the business, and we continue to engage with the authorities in Nigeria, really, to make the case that, with 71 million customers in MTN Nigeria, we really believe that the PSB license would enable us to significantly impact, financial inclusion in that market. And we really hope that we will prevail over time. Other than that, there's no specific news. I think we will close it there. Thanks everybody for your attendance. I hope you find it helpful, and we look forward to communicating our Q3 results in what I guess will be just 2 or 3 months' time. Thank you very much.